Welcome again into this course OAF 111, the Principles of Accounting. My name is CPA Kulwa Mangana, an assistant lecturer from the Open University of Tanzania, Faculty of Business Management from the Department of Accounting and Finance. And today we are going to look at another topic, which is so-called the bank reconciliation statement. So the things that we are going to look at it, how we are going to reconcile, and the purpose of bank reconciliations, and the methods and process that are required into coming to this bank reconciliation statement. Now, to start with, let us see why do we need to come up with this statement, the purpose of the bank reconciliation statement. Now, you're saying due to the timing difference, whereby we have the omissions and errors that are made by the bank or the firm in itself, that actually necessitate or requires us to prepare bank reconciliation statement, whereby we're going to reconcile between the cash book and the records that have been kept by the bank from the bank statement. But again, the balances of the bank statement and the bank account in the cash book account rarely agree. In most cases, you might find that the balances in your cash book account does not agree with the balances in the bank statement, and therefore we need to reconcile, coming up with the bank reconciliation statement, whereby we're going to reconcile to see that the two statements come up to an agreement. Now, the bank reconciliation statement can be used to explain the reasons for the differences and to identify errors and omissions in both documents, so that corrections can be made as soon as possible. Now, reasons for difference between the cash book balances and the bank book balances have been accrued or have been studied over years, and scholars came up with these reasons. One, the very, very big reasons is because of the uncredited items and credited items. These items are the deposits which have been paid into the bank. So these items are too close to the cut-off date of the bank statement, and so do not appear in the statement. They will appear on the next statement. For example, an item that have been processed nearly at the end of the month, of which the bank in itself have been processed. So you won't be able to see it in the bank statement at the end of this month, but you are going to see it at the end of the coming or at the beginning of the coming month. So you're saying banking made shown in the cash book but not in the bank statement. Banking made shown in the cash book but not in the bank statement. For example, maybe you're going to pay for the salaries, then you've paid those salaries very late. For example, you've paid those salaries maybe on 30s of March or 30s of April, and then this transaction, you're going to record them in your cash book as that date, 30s on March. But again, it takes time for them to be credited to your bank statement. Maybe they're going to be credited in the forthcoming month, so you won't be able to see them when you're going to take your bank statement that ends up at the end of 30th March. Okay. Another reason is because of the unpresented checks. So these are the terms that you'll get familiar with them. For example, the first term that I said it, an uncredited check. So we have unpresented check. Unpresented check there, the check is issued by the firm that have not yet been presented to the bank for payment. I repeat, an presented check. These are the checks that they have been issued by the firm that have not yet been presented to its bank for payment. Okay. Another term that is used is the standing orders, but again, it is also a very, very big reasons why you might find these statements do not agree. That there is a difference between the bank statement and the cash book. Now, the standing orders, they are the standing instructions from the firm to the bank to make regular payment. I repeat, these are the standing instructions from the firm to the bank to make regular payment. So you might find that you have a standing order that you're supposed to transfer a certain amount of money to a certain account, but you did not record that in your cash book account. So be sure that you find sort of disagreement between the two statements. Direct debits, they are payment made direct through the bank. payment made direct through the bank. For example, you have your data, and then your data has paid you directly to your bank account without notifying you. So in your bank statement, you're going to have a balance of which you have not recorded it in your cash book. So you'll see there is the two statements are not going to agree. Likewise, with the bank charges, both of us, all of us, we know what bank charges means. So that the charges made by the bank to the company for the banking services. So you won't be able to anticipate that this month, for example, this month, where the bank charges are going to be how much. So actually, you will have to wait until you have the bank statement to be able to anticipate the bank charges, and then you record them. The other item is dishonored check. These are the checks that have been deposited but subsequently have been returned by the bank due to failure of the drawer to pay. I repeat, they are the checks deposited by but subsequently have been returned by the bank due to the failure of the drawer to pay. Dishonored check, they've been dishonored from the bank point of view. Also, we have the credit transfer or direct debit credits. They are the money received from customers directly through the banking system. We also have the interest allowed by the bank. Of course, if you have a lot of money, sometimes if you have a fixed deposit, banks normally they tend to give you, they are the interest received for deposit or fixed deposit. So in a nutshell, those 8 elements that I've tried to mention, they are among the reasons, very, very important, among the reasons for difference between the cash balances and the bank statement balances. Now, I'm going to show you the nature of the cash book and the nature of the bank statement, because I kept on saying cash book, bank balances. Probably some of you are not aware of the cash book. How does it look, and even the bank statement. If you look at these slides now, this is sort of a picture of a cash book. You see, it has 2 columns, the debit side and the credit side. The debit represents an increase, credit represents a decrease from the cash book. Then we have the bank statement. Also, it has the debit and credit in the balances. At this point, I'm certain sure that most of you, at least one or some of you, have the bank account. So you have somehow came across the bank statement. Okay. Now let us go to the processes. Now the theme behind is how to draw a bank reconciliation statement. Drawing up a bank reconciliation statement. We have 2 ways. One, to reconcile the bank statement with the corrected cash book. The first one, you are going to reconcile the bank statement with the corrected cash books. Now, note here the terms corrected cash books. Your cash book has been corrected, so you're going to reconcile the bank statement with the corrected cash book. That is one. But the second one is to reconcile the banking statement with an unadjusted cash book. You have an adjusted cash book. An unadjusted cash book, you reconcile it with the bank statement. Please note these 2 ways. Now, to reconcile the bank statement with the corrected cash book, let us start with this one method of reconciling, that you are going to reconcile the bank statement with the corrected cash book. Okay. Now, 3 steps that are involved. 1, check the bank statement and the cash book to identify the items which have been omitted. I repeat. Check the bank statement and the cash book to identify the items which have been omitted. Go through your 2 statements. Go through your bank statement, go through your cash book, and then try to see, to identify the items which have been omitted. But second, update the cash book with any omissions and errors that have been made by the firm in itself. Go to your cash book, then update your cash book. With any omissions is all transactions that have been omitted. So update the cash book with any omissions and errors. Sometimes you have errors that have been made by the firm in itself. For example, credit transfers, bank interest, standing orders, bank charges. So if you come up across the bank charges, go to your cash book and then update the cash book. Then if you have dishonored check, go to your cash book and then adjust that or correct that cash book. The third step is prepare the bank reconciliation statement. Now you are supposed to prepare the bank reconciliation statement. This is how your bank reconciliation statement is going to look. Take a pause and follow this. You'll have the corrected balances in hand as per cash book. I repeat the statement, corrected balance in hand as per cash book. Then you're going to add and present a check, and then you also add wrong credit by the bank, and then the total of which you're going to list the bank deposit not yet entered in the bank statement, and wrong debits by the bank. Wrong debits by the bank. Now, to understand, I think it's very, very crucial but important to give you a hypothetical example that will make it easier for you to understand this topic. Okay, now look at this question. Here we have a cash book with a bank column, and then below here you have a bank statement. Okay, take pause and try to read these items or elements within the cash book and within the bank statement. I'll pause a bit so that you can follow. You have a balance brought forward, and you also have balance carried forward. You have transaction WLE 1000, T-Cheng 2000, and SIN 1400 from the debit side, and you also have transaction from the credit side of your cash book. Likewise, you have your bank statement. You have a December balance there. So this bank statement is likely the same balance that you're going to have as a bank statement that you request or require from the bank, from your own bank account. So now you have different transaction from the cash book and different transaction from your bank statement. Now here you'll have to go back to your cash book, and then follow those steps that I've been explaining. One, check the bank statement and the cash book to identify the items which have been omitted. Second, update the cash book, and then you're going to prepare your bank reconciliation statement. Now identify the items which have been omitted in the cash book. If you identify the items that have been omitted in the cash book, and then you're going to correct it, and then you come up and prepare your bank reconciliation. And this is how your bank reconciliation is going to look like. You have the collected balance in hand as per book. You add and present a check. You list a bank deposit not yet entered in the book statement. Then you have balance in hand as per bank statement. And you'll see the balance that is going to be reflected here from the bank reconciliation statement is going to be reflected, or is going to be the same as that balances in your bank statement. So only adjusted caused by timing difference. Only adjusted caused by timing difference. Now to reconcile, this is another method to reconcile the bank statement with unadjusted cash book. To reconcile the bank statement with unadjusted cash book. Two steps here are involved. One, check the bank statement and the cash book to identify the items which have been omitted. So the steps is the same as the previous ways, the previous method that we used to come up with the reconciliation statement. You will have to check the bank statement and cash book to identify items which have been omitted. But second, then prepare the bank reconciliation statement. You see, it's very, very simple. Now begin with an adjusted cash book balance and end with the bank statement balance. Begin with an adjusted cash book balance and end with the bank statement balance. Now you see here you have the corrected balances in hand as per cash book, and then you have to do some adjustment here. You add credit transfer, you add bank interest, you add unpresented check, you add wrong credit by the bank. Then you're going to list the standing orders or direct debits. You're also going to list the bank charges, dishonored check, bank deposits that are not yet entered in the bank statement, wrong debits by the bank. Then you're going to have finally the balance in hand as per bank statement. I hope now you understand. And with very common sense, you can even take a look at these elements. For example, the bank charges. Of course, you're going to remove them because you're going to remove the bank charges because the bank charges have been posted into your bank statement. But now you have to adjust, to come up with the figures that are actually your bank statement will resemble with your cash book. Now, example, the fact that the same, let us took the same examples, but the cash book was not updated. Now here, if you look at this, the bank reconciliation statement as at that date, this is how you're going to see. Take a pause and look at it. Corrected balance in hand as per cash book, it is with that figure 4,800, and you'll have to add the credit transfer of 300, back interest which is 50, and present the check of 100. So the total, if you take the total of 300, you plus 50, you plus 100, is you're going to get 450. So if you add 450 with that corrected balance in hand as per cash book, which is 4,800, you're going to get 5,000 with 5,250. Then you less the bank charges of 30, standard check, bank deposit, and direct debit, and to arrive at that balance. So up to that point, can be sure that you've been able to understand bank reconciliation statement. Is very simple process to come up with it. So maybe let us see some of other issues that are very also prominent into this course. Okay, when we have post-dated check, so what do we mean by post-dated check? Post-dated check, it is a check which has been it is a check which has not yet matured within the current accounting period. Post-dated check, these are the check which has not yet matured within the current accounting period. Now, accounting treatment, the check should be held by the cashier, and no entry should be made until the check becomes mature. I repeat, this is as regard to the post-dated check. For example, you have a check that has been dated in future time. Then you are not supposed to make any entry today because that check has been issued today, but it has been post-dated. It has been dated to be processed in future time. So the check should be held by the cashier, and no entry should be made until the check becomes mature. If a post-dated check has been entered in the cash book, make correcting entries. So how are you going to make correcting entries? You are going to debit the data, you credit the bank with an amount of the post-dated check. Why debtors? Because we assume that we are going to be you're going to affect this transaction is going to affect the debtors and your account. That is an assumption. Okay. Now we also have stale check. Now what do we mean by stale check? Stale check, it is a check which has been drawn for more than 6 months but has not yet gone through the bank of the drawee. This is a check that has been drawn for more than 6 months but has not yet been gone through the bank of the drawee. Now you'll also have to make an adjustment here. You'll have to correct if you have recorded this check. Accounting treatment is you'll have to debit your bank account, and then you're also going to credit your creditor with an amount of the stale check. Okay. Now we have errors that are made by the bank because with the bank transactions, those are the human. So we have human errors. Sometimes human makes mistakes. So we expect there's some errors that will be or that have been made by the bank. For example, errors corrected within the current accounting period, errors not corrected within the accounting period. But these errors, we are going to categorize them into 2 categories. One, the first categories are those errors that are corrected within the current accounting period. And the second categories are those errors that are not corrected within the current accounting period. So let us start by looking at the errors corrected within the current accounting period. As the errors has been corrected by the bank within the current accounting period, no adjustment is needed. So with these errors, we don't need any adjustment because they've been corrected within the accounting period. For example, here, look, take this example. We have a bank statement here, and then you have an error here whereby a check of 300 has been debited, and again the bank itself has credited that amount, so you don't need to correct because it is sort of a contraintuitive from the bank point of view. But now errors that have not been corrected within the accounting period, that errors has persisted into the accounting period. For example, an amount of let's say 1,000 which should be credited into the owner's personal account was wrongly credited by the bank to the company's bank account. Now the balances of the cash book is 4,000 and the bank and the balance of the bank statement is 5,000. So you see there's a difference here. The balance of the cash book is going to reflect 4,000, but if you go to your bank statement, there is a balance of 5,000. Now you see you'll have to reconcile. Now the bank reconciliation statement, the balance in hand as per cash book is 4,000. Then you're going to add it into your bank reconciliation statement as wrong credited by the bank. You're going to add it as an amount as wrong credited by the bank, 1,000, to arrive at an amount of 5,000. So as it is an error made by the bank, no adjustment is needed in the company's cash book. You don't have to adjust your cash book because that error has been accrued from the bank point of view. Now let us look at another element, at the different opening balances of the cash book and the bank statement. Different opening balances of the cash book and the bank statement. Now the following steps should be taken. One, should reconcile the opening cash book balance with the opening bank statement balance. You really need to reconcile the opening cash book balance with the opening bank statement balance. And second, the adjusting items for the opening balances should not appear in the bank reconciliation statement of the current period. So for the current period, the adjusting items of the opening balances is not supposed to appear in the bank reconciliation statement. And then you should prepare the bank reconciliation statement following into account what we've discussed above. Now to make it easy, understand, look at these figures here. You have the cash book column here again, and you have the bank statement. Now here, look at this tick-on whereby you have an uncredited item and then you have an unpresented check. Here under the bank statement, you have the adjusted items for opening balances. Now take a look at these figures. At least you can understand something here that refers to different opening balances of the cash book and the bank statement. Now to answer that, because the requirement here is we are supposed to come up with the bank reconciliation statement. As I've said, the adjusting items for the opening balances should not appear in the bank reconciliation statement. And as you can see this bank reconciliation statement here, you can't find the adjusting opening balances. We have the balances in hand as per cash book. We have that figure 10,600. You add unpresented check of 2,400, and then you less the uncredited items and the bank charges, so that in the end you're going to have the balance in hand as per bank statement. You see here we have a balance in hand as per bank statement of 11,500. Now go back and look at your bank statement. You'll see that a balance of 11,500 at the beginning, December 1 balance at the beginning of the period. Okay, so here you can see this is how we are going to you're going to correct or to account for different opening balances of the cash book and the bank statement. Okay. Now this is how your cash book is going to look like. You have the opening balances 11,238, and then you have other elements on the credit side. You have that element of rent, service charge, and the balance carried forward. So you're going to close that account. The bank reconciliation statement as that date is going to be as you can see here. You have the corrected balances as per cash book of 7,038. You add unpresented check, and then you less than credited amount. But look here with the unpresented check, you're supposed to take that 1,400 and that 2,100. Now, where did we get that 1,400 and 2,100? Now, go back to your cash book here. You'll see those elements that I I made it in color in a box and called them unpresented checks. So these are the elements that I've taken and put here under the unpresented check. Okay. The other element is the bank overdraft. Now, what do we mean by bank overdraft? You probably have come across this word bank overdraft. Now, when there is a bank overdraft, the presentation of the bank reconciliation statement can be the same as those needed for a debit balance, but begins with a negative figure. So bank overdraft will be represented by a negative figure. So when you have a bank overdraft, the representation of the bank reconciliation will be the same as those needed for the debit balances, but begins with negative figures, or the opposite of those needed for a debit balance. That means you're supposed to write sort of a credit balance. An example of it, take an example of your cash book again and the bank statement here. Take a look at these figures, and then you have your cash book here. Take a look at that cash book. Now when you want to reconcile here, since your cash book it has a balance carried forward, and then from the debit side, and you have the from the credit side you have transaction there, but you see this cash book it goes into a negative because it balances on the other side. So if you come up with to your bank reconciliation statement, corrected balances per cash book, this is an overdraft. You see, we have a bracket of 460 that represent an overdraft. So you will go on with the same or normal process. You add unpresented check, you less uncredited items, then you have the balances per bank statement. Okay, you see the balances per bank statement, an overdraft of 360. This resembles the same balance as the given bank statement that you had from your bank. Okay, so by saying so, you are now comfortable with this course, with this subject of today. We were trying to look at the bank reconciliation, so we went into the processes and we looked at some of the items that are normally considered when we are preparing the bank reconciliation statement. I thank you very much for listening, and I hope you have understood it well. So keep in touch. If you have anything, my account is open. Be free to contact me. Thank you for listening, and enjoy the course.